This video is for educational purposes only and is not financial advice. I'm not a licensed financial advisor. Everyone's financial situation is different, so please consult with a qualified professional before making any investment decisions. Here's something that'll blow your mind. Two investors buy the same Nifty 50 ETF on the same day. 5 years later, one has made 11.8% returns while the other sits at 12.3%. How is that even possible? Same index, same starting point, wildly different results. The answer lies in 8 hidden traps that silently destroy ETF returns, and most beginners have no clue they exist. What are ETFs? The 60-second crash course. Before we dive into these wealth-destroying mistakes, let's get crystal clear on what ETFs actually are. Exchange-traded funds are investment vehicles that trade on stock exchanges just like regular stocks. But instead of owning one company, you're buying a basket of securities. Could be stocks, bonds, commodities, you name it. Most ETFs track specific indexes. Think S&P 500, Nifty 50, or sector-focused indexes like technology or healthcare. The promise? Instant diversification and rock-bottom costs. Buy one ETF, own hundreds of companies. Sounds perfect, right? That's exactly where beginners get trapped. ETFs are marketed as easy investing, and they can be, but only if you dodge these 8 critical mistakes that separate winning investors from everyone else. Mistake number 1, not understanding what you're actually buying. Most people think all ETFs are safe because they're diversified. That's like saying all cars are safe because they have airbags. A semiconductor ETF might hold 30 different chip stocks, but guess what? You're still 100% concentrated in one volatile sector. Consider the VanEck Semiconductor ETF. It sounds diversified with dozens of holdings, but the top 3 companies make up over 41% of the entire fund. NVIDIA alone represents nearly 20%. If chip stocks tank, your diversified ETF tanks with them. And here's the kicker. A crypto ETF behaves nothing like a bond ETF, a clean energy. ETF isn't remotely similar to a broad market index fund, yet beginners pile in without reading what's under the hood. The fix? Before buying any ETF, read the fund's fact sheet. Understand exactly which index it tracks, see the actual sector exposure, and know the top 10 holdings. If you can't explain what you're investing in to a 12-year-old, you shouldn't own it. Mistake number 2, ignoring tracking error, the silent profit killer. Here's where that opening mystery gets solved. An ETF's entire job is to match its benchmark index. Tracking error measures how badly it fails at that job. A tracking error of 0.1% to 0.3% is excellent. Anything above 0.5% is a red flag. Why does this happen? Poor fund management, excessive fees, low liquidity, and something called cash drag when the fund holds too much uninvested cash. Real example. 2 Nifty 50 ETFs. Over 5 years, one delivers 11.8% annualized returns, the other 12.3%. Same index, 0.5% difference in tracking error, vastly different outcomes. That 0.5% gap cost you thousands over decades. The HDFC Nifty ETF has a tracking error of just 0.04%, while some competitors sit above 0.15%. Guess which one puts more money in your pocket? Your action step. Before buying, compare tracking errors across all ETFs tracking the same index. This single metric can be worth tens of thousands of dollars over your investing lifetime. Mistake number 3, overlooking expense ratios. The compound killer. 0.1% versus 0.5%. Sounds like nothing, right? Wrong. Dead wrong. Let's do the math with real numbers. You invest $100,000 at 10% annual returns over 30 years. With a 0.1% expense ratio, you end up with roughly $1,745,000. With a 0.5% expense ratio, about $1,532,000. That seemingly tiny 0.4% difference just cost you over $212,000. The S&P 500 offers a perfect case study. SPY charges 0.0945%, while VOO and IVV charge just 0.03%. Over decades, that difference compounds into massive wealth destruction. For every $10,000 invested, SPY costs $9.45 annually, VOO costs $3. Multiply that over 30 years with compound growth, and you're looking at a six-figure penalty. The fix is simple but powerful. For plain vanilla index ETFs, always choose the lowest expense ratio. Period. Only pay higher fees for genuinely unique strategies that can't be replicated cheaply, and most can be. Mistake number 4. Chasing past performance, buying yesterday's winner. Remember clean energy ETFs in 2020? They surged over 150%, and investors poured billions in. Then 2021 hit. Average losses of 11.2%. Those who chased 2020's performance bought at the peak and watched their money evaporate. Or take the ARK Innovation ETF, ARKK. In 2020, it exploded 152.8%. Investors rushed in during 2021, expecting the magic to continue. Instead, down 23.38% in 2021, then an absolutely brutal 66.97% crash in 2022. If you invested $100,000 at the peak, you'd be sitting on roughly $33,000 2 years later. This isn't just bad luck, it's cyclical reality. Sector ETFs that crush it 1 year often underperform the next because performance doesn't repeat, it reverts. Last year's winner becomes this year's loser with stunning regularity. The fix: invest based on long-term allocation strategy, not last year's star performer. Build a portfolio around your goals, risk tolerance, and time horizon, not whatever CNBC is hyping this week. Mistake number 5, low liquidity and AUM, the exit trap. Here's a mistake that doesn't matter until it destroys you. ETFs with less than $50 million in assets under management face real closure risk, and when they close, you're forced to sell, often at the worst possible time. Low daily trading volume creates another nightmare: wide bid-ask spreads. Think of it as a hidden tax on every trade. On a liquid ETF like VOO, the spread might be 2 cents on a $300 share. Basically nothing. On a thinly traded ETF, could be 50 cents to $2, costing you 0.5% to 2% on every single transaction. Emerging market ETFs can have bid-ask spreads of 4 to 100 basis points. That's up to 1% lost on entry, another 1% on exit, 2% gone before you even start investing. The fix: check 2 numbers before buying any ETF. Daily trading volume should exceed 100,000 shares, and assets under management should be above $500 million. Stick to these minimums and you'll avoid the liquidity death trap. Mistake number 6, over-diversification, the illusion of safety. Here's where smart investors make dumb mistakes. They own 10 different ETFs thinking they're diversified. Plot twist: 7 of them hold the same stocks. You've got one S&P 500 ETF, one large cap growth ETF, one total market fund, one dividend aristocrats ETF, and 3 sector ETFs. Congratulations! You're still just holding S&P 500 exposure wrapped in multiple expensive packages. You're paying 5 expense ratios for one position. Over-diversification dilutes returns without reducing risk. If your best investment gains 50%, but it's only 2% of your over-diversified portfolio, who cares? The impact is invisible. Meanwhile, you're tracking dozens of holdings, dealing with multiple tax lots, and paying unnecessary fees. True diversification means exposure across genuinely different asset classes: domestic equity, international equity, bonds, REITs, maybe commodities or crypto, not 5 ETFs that all own Apple, Microsoft, and Amazon as their top holdings. The fix: audit your portfolio for overlap. Tools like Morningstar's X-Ray or ETF Research Center exist to show you which stocks appear across your ETFs. Consolidate redundant positions. Favor broad index funds over multiple narrow ones, unless you have a specific strategic reason. Mistake number 7, thematic and sector ETF traps. Hype over substance. AI ETFs, robotics ETFs, cannabis ETFs, hydrogen ETFs. They sound exciting, cutting edge, like you're investing in the future. Here's what they actually are: concentrated risk bombs launched at peak hype, charging premium fees. Most thematic ETFs carry expense ratios of 0.6% to 0.9%, triple the cost of broad market funds. Clean energy ETFs illustrate the trap perfectly. After languishing for a decade, they exploded in 2020, growing assets from $3 billion to over $27 billion as investors rushed in. Then reality hit: massive volatility, underperformance, and painful losses as hype faded. Thematic ETFs concentrate your money in narrow slices of the market. When that slice is in favor, you look brilliant. When it's not, and it will rotate out of favor, you're holding dead weight while broad market indexes keep climbing. The fix is straightforward. Keep thematic ETFs under 10% of your total portfolio. Your core holdings, 70% or more, should be broad market index ETFs. Play with sectors in your satellite allocation, but never make them your foundation. Mistake number 8. Tax inefficiency ignorance. Uncle Sam's cut. Different ETF types get taxed completely differently in different countries, and most investors have zero clue. Equity ETFs held over 12 months face 10% long-term capital gains tax on amounts exceeding $1,250. That's about 1 lakh rupees. Sell within a year? 15% short-term capital gains tax. Gold ETFs held over 12 months now get taxed at 12.5% without indexation, a recent rule change many missed. Debt ETFs? Taxed at your income slab rate regardless of holding period, with no indexation benefit. Frequent trading amplifies the damage. Every sale creates a taxable event. Trade monthly instead of annually, and you could be paying 15% short-term capital gains repeatedly instead of 10% long-term once. The fix: understand tax treatment before buying any ETF. Structure your portfolio to hold equity ETFs long-term in taxable accounts. Minimize turnover to avoid short-term capital gains. When in doubt, consult a tax advisor. The money you save will dwarf the consultation fee. How to choose ETFs properly. The 4-step framework. Let's flip the script. Instead of making mistakes, here's how to choose ETFs like a professional. Step 1. Identify the specific index or asset class you want exposure to. Don't start with a fund. Start with your portfolio need. Step 2. Compare all ETFs tracking that index side by side. Don't pick the first one you find. Step 3. Check 5 critical metrics. Tracking error must be under 0.5%. Expense ratio should be the lowest available. Assets under management should exceed $500 million. Daily trading volume must be substantial. Fund house reputation matters. Stick with established providers like Vanguard, BlackRock, State Street, or Fidelity. Step 4. Buy and hold. Rebalance annually, not monthly. Use ETF screeners on platforms like Morningstar, ETF.com, or ETF Database to compare funds objectively. The right ETF portfolio, core satellite strategy. Here's the professional allocation framework. Your core, 70% of assets, goes into broad market index ETFs. Think Nifty 50, S&P 500, or total market funds. Low cost, high liquidity, boring and effective. Satellite allocation, 20% of assets, adds international equity ETFs and debt ETFs for genuine diversification across asset classes and geographies. Tactical positions, the final 10%, can include sector or thematic ETFs if you have genuine conviction. This is where you take calculated risks, not with your entire nest egg. Rebalance when any allocation drifts 5% from target. Not every month, not every week, once a year with 5% bands. This discipline keeps you from chasing performance while maintaining your strategic allocation. Action steps: what to do right now. First, audit your current ETF holdings. Check tracking error, expense ratios, and liquidity metrics for every fund you own. Be ruthless. If it fails the test, replace it. Second, consolidate redundant ETFs. If you own multiple funds with massive overlap, you're paying extra fees for zero benefit. Third, favor broad over narrow. Unless you have a specific strategic reason, ditch complex thematic funds for simple broad market exposure. Fourth, set an annual review reminder. Check your allocation once a year, rebalance if needed, then ignore market noise. Finally, and this might be the most important, ignore financial media hype about hot sector ETFs. By the time something hits mainstream news, the opportunity is already priced in. You're not early, you're late. Here's the bottom line. ETFs are simple tools. Don't complicate them. Broad market exposure, rock bottom costs, high liquidity, and long-term holding, that's the formula. The 8 mistakes we covered destroy billions in investor wealth every single year, but now you know exactly how to avoid them. 2 investors buying the same ETF can get wildly different results, but it's not luck, it's knowledge. You now have that knowledge. Use it. So here's my question for you. Which of these 8 mistakes are you making right now? Drop it in the comments. I'd love to hear where you're going to make changes. And if this video saved you from even one of these traps, hit that like button, share it with someone who needs to hear this, and subscribe, because we're just getting started breaking down exactly how to build real wealth through smart investing. Thanks for watching, and I'll see you in the next one.